after benefits, we're going to be talking about, well, I'll show you a bull and bear sector map. A lot of you have already seen this, but we'll explain it because it's very important, especially for trading ETFs, to have this formation in mind. I'll talk about some tips for trading ETFs that some of you may not know. We'll talk about how you can take a list of exchange-traded funds that are focused to a single sector or industry group, and you know what? You can trade them literally all the time. You don't really even have to, you can become a specialist right there. You don't have to wander all over with scanners and everything else. You can just take 4 or 5 of these ETFs. You can go long, you can go short, and you can have 2 or 3 of these focus groups, I call them, and you really don't have to spend a terrific amount of time on research. You'll have it all done. And of course, we'll do a quick review. Okay, let's talk about some of the benefits of trading exchange-traded funds. And I may throw one in here that you don't know, maybe. Okay, first of all, this is a simple one, and we all know this now. With exchange-traded funds, you can purchase an entire sector, either U.S. and or international. This is a fantastic thing that up to now we couldn't do. If somebody upgrades the entire semiconductor, one of the big brokers upgrades the entire semiconductor industry, or today they downgraded a lot of semiconductors, you don't have to know the fundamentals of each semiconductor company. You can buy or sell that single sector. I'll put this back later. Actually, you can also work the U.S. sectors and the international sectors pretty well together. It stands to reason a lot of the times that if a U.S. sector starts moving higher, so will the international. We do tend to lead. If you look at the PHO, which is the power shares, this is one I'm just going to keep staring at because I really believe that in the future water is going to become a commodity, a very highly sought after, very much in demand commodity. I think we're using up way more than anybody's talking about. And I don't think that's only in the U.S. I think it's global. So what you can do is watch the PHO, which is the Power Shares Water Resources ETF, the U.S. one, and you can watch the PIO, which is the International the Power Shares is the fund family, the International Water Resources Fund. And I suspect this is going to go across the globe, but you can sequester or just do U.S. The one thing you have to keep in mind with the PHO or the PIO, especially the PHO, I'm not sure about the PIO so much, but a large group of the companies in that are industrials. And you have to be careful with these ETFs. You've got to go in and look at the components because you could be very much surprised as to what you're getting into if you just look at the name of them. So there's industrials, there's healthcare, there's all kinds of companies in the water resources, for instance, that may not occur to you that even belong there, but they certainly are related. Another benefit to using ETFs is you spend less time on research. That's a given. You don't have to investigate the entire semiconductor community of stocks. If the group of semiconductors, or if oil, or if financials, or if healthcare is going up, you can buy, as you know, that sector with one of the big fund family exchange-traded funds, and you're golden. You have done it. Now that leads me to the next one, which is really important. Has anybody in this room ever bought the only stock in a group of stocks that are moving higher? Have you ever bought the only stock that went nowhere? And I know you guys have heard of people who have done that. Maybe you haven't done it yourself. I admit to doing that. I'll buy the only software stock that doesn't move when the rest of the software stocks scream higher. Buy the only pharmaceutical that sits around and everybody else is screaming, and you're like, Oh, thank you so much. What did I do wrong? With ETFs, you don't let yourself in for that kind of aggravation because you're buying the whole basket of stocks, at least that represent the leaders within that industry. You're buying the whole thing. So if pharmaceuticals go up and you buy pharmas, one of these ETFs, then you are going to go up with it. Just so maybe you want to sell short and you sell short the only one that doesn't fall, the only stock that doesn't fall. Just so if there's movement in that group, if there's movement in that sector, the ETF is going to move. And that helps us make more profits faster and easier. And isn't that what it's all about? The next point is the diversity. I won't stay on this. We all know it already if we trade ETFs. We get lower risk with exchange-traded funds because, again, and I used to do this with biotechs until I just gave up on them. I would buy and biotechs are legendary for this, I'd buy the only biotech company that would gap down 5 points the next morning. And now when trading biotechs, one needs to know that they wander around pretty much on the results of their clinical trials and so forth as a single group. They don't all move together as much as other groups because each of the biotech companies has a different agenda. They can be powerful moves up or down. However, trading the biotech ETFs like the XBI or the IBB, the iShares, that takes the worry out of being close to one of these potential fall down companies, because if one company falls down, the whole ETF doesn't crater and gap down 5 points. You just have a little hitch in it. If the other ones are moving up, that takes out of that risk. Finally, as you all know, ETFs are wonderful hedging vehicles against long-term stock portfolios. You can use them for a myriad of reasons in this, but we only have an hour, so I want to keep going. Here's one quick point for you, though. Say you own shares in a big, we'll just say, for instance, in a big tech company. Say you own 40 million shares of Microsoft that your dad gave you when you were 12 and you've always owned it, and you just don't want to get rid of it, and it's gone up and split and carried on and everything, and you've just had it, and you're making good money, you don't want to get rid of it, and you see there could be a pullback in technology. It's simple. You short one of the technology stocks or buy one of the technology ETFs or buy or buy one of the leveraged inverse or inverse ETFs, and then you can kind of, if the market pulls back, that's one way of hedging. Another thing you can do is this. Say you've got a stock and you want to take a loss in it at the end of the year, and you want to take the loss on your income tax, but you really like the stock, you really think the industry group has a chance of going higher the first of the year. You don't want to give up, you want to take your loss. And you can't replace it because the IRS will know. So what you do is sell your stock at the end of the year, take your loss, and then buy an ETF in that industry group immediately that may be at a low point. They don't know that you're replacing almost like and like. Buy an ETF that's in that industry group, then you're still exposed to that group and the chance that they go higher.